The Fed says 32 major banks passed the 2026 stress tests after taking more than $700 billion in projected losses in a brutal hypothetical downturn. That is good news. Seriously, you want the biggest banks to survive a financial crash drill. But here's the part that gets lost in the headline. Banks passed is not the same thing as your money is automatically safe in every account, your credit line is untouchable, your loan approval is easy, your business funding is secure, and your paycheck is protected. Those are different questions, and if you mix them together, you hear one comforting sentence from the Fed and accidentally translate it into everything in my wallet is fine. That is where people get blindsided. A bank can be strong enough to survive a nasty recession scenario and still become pickier with you. The vault can be reinforced while the ATM limit, the loan officer, the credit card algorithm, and the small business banker all suddenly start acting like they found a new religion called risk control. So the real question is not just, did the banks pass? The real question is, did your household pass? By the end, you should understand the difference between bank solvency, deposit insurance, credit access, borrowing costs, job exposure, and the practical moves to make this week before a calm banking headline turns into a very expensive personal surprise. Start with the 3 separate doors. Door 1 is bank solvency. That means, can the bank absorb losses without falling apart? Door 2 is deposit protection. That means if your bank or credit union fails, is your specific money covered by insurance rules? Door 3 is credit access. That means will the bank lend to you, at what price, with what documents, and under what conditions? The Fed's stress test mostly checks Door 1. FDIC and NCUA rules help answer Door 2. Your income, debt, credit score, collateral, documents, job stability, account history, and the bank's appetite for risk decide Door 3. Same building, 3 different locks. And the mistake is assuming one unlocked door opens all the others. Banks passed means the largest banks had enough capital to stay above required levels in a severe hypothetical downturn. It does not mean every deposit balance is insured no matter where it sits. It does not mean every borrower gets cheaper credit. It does not mean your credit card limit, HELOC, auto loan, business line, or mortgage approval is protected by good vibes and a clean bank lobby. A strong banking system matters, but your household can still get squeezed inside a system that is technically strong. Think of it like this. The bank passed a crash test. Great, but that does not mean your gas is cheaper, your insurance premium is lower, your repair bill disappeared, or the lender financing your car suddenly became generous. The crash test tells you something important. It does not tell you everything. Here is what the Fed actually tested. A stress test is not a forecast. The Fed is not saying, this exact recession is coming. It is also not promising, no bank can ever fail. It is more like forcing the biggest banks through a brutal financial fire drill. What happens if unemployment jumps, asset prices fall, borrowers miss payments, commercial real estate gets uglier, trading positions lose money, big financial counterparties stumble, and customers still expect the bank to keep operating like nothing happened? The Fed is asking, if a bunch of financial pain hits at the same time, does the bank still have enough padding? That padding is called capital. Capital is the bank's shock absorber. If a bank makes loans, buys securities, trades in markets, or deals with big financial institutions, some of those bets can go wrong. Capital absorbs losses before depositors, taxpayers, or the wider system become the emergency plan. Think of capital like the crumple zone in a car. You do not brag about using it, but if there's a crash, you definitely want it there. Passing the 2026 stress test means the biggest banks kept enough of that crumple zone in the Fed's hypothetical crash. Again, that's better than failing. Nobody should be rooting for weak banks unless their hobby is chaos with monthly statements. But passing does not mean the ride becomes comfortable for you. It means the bank may survive the crash test. It does not mean loans are easy, rates are friendly, paperwork is light, credit limits are stable, or the person reviewing your application woke up feeling generous. This is why the phrase, "the banking system is resilient," can be true and still not feel comforting when your card issuer trims your limit, your bank asks for updated documents, your small business lender wants fresh financials, or your loan approval turns into a scavenger hunt. The 2026 test covered 32 major institutions and projected more than $700 billion in losses. those losses did not all come from one place. Credit cards, mortgages, business loans, commercial real estate, trading books, and counterparty exposures can all behave differently. A counterparty is just the other side of a financial deal. If a giant trading partner cannot pay what it owes, the losses can move fast. So the Fed is not only asking, what if some homeowners miss payments? It is asking, what if several kinds of stress show up at once and the bank still has to function? And this is where the everyday impact begins. When banks see certain categories as riskier, they do not wait politely until a recession gets a name tag. They start protecting capital early. Protecting capital sounds responsible because it is. It also means banks may charge more for risk, lend less, reduce unused credit exposure, demand more collateral, slow approvals, and treat your paperwork like sacred evidence in a courtroom drama. Banks can pass the exam and still become less generous. In fact, passing the exam can remind them exactly where the weak spots are. Take Erica in Phoenix. She is not reckless. She has a steady job, a normal checking account, a $9,000 credit card limit, a used SUV loan, and a plan to use a modest home equity line to replace an air conditioner before summer turns her living room into a slow cooker. She hears that the big banks passed the stress test and thinks, reasonably, okay, maybe the financial system is calming down. Then her card issuer cuts her limit from $9,000 to $6,000. Her home equity lender asks for 2 years of tax returns, recent pay stubs, a fresh property valuation, proof of insurance, and a cleaner debt picture. The contractor's financing offer comes back with a higher monthly payment than she expected. Nobody on TV says banking crisis. Her bank does not fail. Her deposits do not disappear, but her options get narrower. That is the real-life version of a stress-tested system. The institution may be built to withstand losses, while the customer feels the tightening. It can show up as a lower limit, a higher rate, a smaller approval, a slower underwriting process, more questions, more documents, or a polite email that somehow says, "Thank you for your loyalty," while removing your breathing room. To the bank, that is risk management. To you, it's a Tuesday that got more expensive. Is my money safe? For most households, the stress test result is useful background. It supports confidence that the largest banks are not obviously fragile under the Fed's severe scenario. Recent banking updates also describe the broader industry as resilient, with strong capital and liquidity. That means the system was not flashing a giant "everybody run for the exits" sign. But deposit safety is not a mood. It is not based on whether your bank has a famous logo, a smooth app, a marble branch, or commercials where everyone smiles while paying bills like that is a normal human experience. Deposit safety depends on the legal institution, the account type, the account title, the ownership category, and the balance. In the United States, the standard FDIC insurance limit is generally $250,000 per depositor, per insured bank, per ownership category. For federally insured credit unions, NCUA coverage works in a similar basic way. That phrase is boring for exactly as long as your balance is small. Per depositor, per insured bank, per ownership category sounds like a sentence designed to make you check your phone. But if you sold a house, received an inheritance, run payroll, hold a large tax reserve, manage escrow money, or park cash before buying property, that boring sentence can become very expensive to misunderstand. You do not automatically get extra coverage because you split money into 5 cute account names at the same bank. Emergency fund, vacation fund, tax paying, and please stop ordering delivery can still be the same ownership category at the same insured bank. If you have $6,000 in checking and $18,000 in savings, this probably is not your emergency. If you have several $100,000 sitting in one place, you need to check the structure. Not panic, check. Ask plain questions. Is the institution FDIC insured or federally insured by the NCUA if it is a credit union? What is the legal name of the bank or credit union actually holding the money? Whose name is on the account? Is it individual, joint, trust, retirement, business, or another ownership category? Are beneficiaries listed correctly if you were using payable on death or trust-style accounts? Is any portion above the insured limit for that ownership category at that institution? This is not dramatic. This is basic financial plumbing. You want to find the leak before the ceiling is on your head. And if your cash sits at a brokerage, slow down before assuming the same rules apply. A brokerage account is not automatically a bank deposit. A bank stock is not insured. A bank bond is not insured. A money market mutual fund is not the same thing as an FDIC-insured savings account. Some brokerage cash sweep programs move uninvested cash into partner banks, and that swept cash may be eligible for FDIC coverage at those partner banks. But you need to know which partner banks, what limits apply, whether the same partner bank appears elsewhere in your financial life, and whether your cash is actually swept into banks or sitting in a fund. The logo on the app is not the insurance policy. That is the bank safety lane: institution, insurance, ownership, limits, beneficiaries, and where the cash really sits. Now move to the borrowing lane, because this is where banks past can still turn into you still pay. Banks do not protect capital by writing inspirational quotes in the annual report. They protect capital by controlling risk. That can mean tighter standards, higher pricing, smaller credit lines, more collateral, fewer exceptions, and a sudden fascination with every detail of your financial life. Credit cards are often where people feel this first because credit cards are unsecured. That means there is no house, car, or equipment attached as collateral. The bank cannot repossess last month's groceries, your gas fill-up, your kids' sneakers, or the dinner you put on plastic and now remember with regret. With a mortgage, the lender has a house. With an auto loan, it has a car. With a credit card, it has your promise to pay, your payment history, and a collections department that would like a word. So banks look not only at what you borrowed, but what you could borrow. If you have a $10,000 credit limit and a $2,000 balance, the bank still sees the possibility that you could run that balance much higher tomorrow. That unused limit is exposure. Exposure is the bank's fancy word for money we might have to worry about if things get ugly. If the bank wants to reduce exposure, it can trim limits even before you miss a payment. To you, it feels personal. To the bank, it is portfolio math wearing a customer service sweater. This is why utilization matters. Utilization means how much of your available credit you are using. If you have a $10,000 limit and a $7,500 balance, you are using 75%. A lender may see that as stress, even if you have never missed a payment. Fair? Not always. Predictable? Yes. If you plan to apply for credit soon, try to get card balances below 30% of the limit, and lower is better. If money is tight, look first at expenses that move real cash: insurance premiums, unused subscriptions, food delivery, phone plans, branded groceries, duplicate streaming services, and automatic charges you forgot existed because apparently every app wants a monthly allowance forever. Home equity lines can also get colder. A HELOC is a home equity line of credit. You borrow against the value you have in your home, but the bank still cares about income, credit score, debt-to-income ratio, property value, job stability, insurance costs, and whether your documents look normal or like a treasure map with coffee stains. If home prices soften in your area, if your hours get cut, if insurance jumps, or if you added a car payment and a furniture loan, the house alone may not carry the application. Banks do not lend against the home value you emotionally prefer. Rude, but useful to know before the air conditioner dies. Auto loans, personal loans, and student loan households face the same general logic. The lender is asking, how much room does this borrower actually have if income gets weaker or prices stay high? So do not add avoidable debt right before applying for major credit. Do not finance a couch 2 months before a mortgage application. Do not open a store card to save 15% while trying to qualify for an auto loan. The discount is cute, the underwriting damage can be expensive. A lender does not know your intentions. It sees balances, inquiries, income, collateral, and risk. Small business owners need to pay extra attention because business credit often tightens quietly. A line of credit is not just money already borrowed, it's money the bank has promised you can borrow if you draw on it. In cautious periods, banks review those promises. If your business uses a credit line for inventory, payroll timing, equipment, rent, receivables, or seasonal cash flow, your lender may ask for updated profit and loss statements, tax returns, bank statements, receivables, payables, collateral details, and a debt schedule. In easy times, a decent relationship may carry you. In cautious times, paperwork carries you. So ask before renewal season, what financial statements will you need? What ratios matter? How much of my unused line is still available? Can the bank reduce the limit before maturity? What collateral is tied to the line, and what happens if revenue dips for one quarter? These are boring questions. Boring questions asked early are cheaper than urgent questions asked after payroll is due. Now connect this to paychecks without turning it into a horror movie. Even if you never apply for a loan, credit conditions can still touch your income. Many employers use credit to manage timing. Payroll comes due every 2 weeks. Inventory has to be bought before customers pay. Vehicles, equipment, rent, insurance, supplier costs, and lease payments arrive whether sales are smooth or not. If financing gets more expensive or harder to renew, businesses may delay expansion, freeze hiring, reduce overtime, shrink inventory, postpone equipment, or push raises into next year while calling it discipline, which is corporate for please admire your smaller opportunity. The stress test result reduces the odds of a broad, large bank lending collapse. That matters. But tighter underwriting can still pressure Main Street one renewal at a time. A bank can be healthy. A borrower can be rejected. A rejected borrower can become a weaker employer, and that employer might be yours. Ask a practical question. How dependent is your employer on credit? If you work for a cash-rich company with stable revenue, maybe not very. If you work for a builder, dealership, restaurant group, logistics firm, retailer, manufacturer, startup, real estate company, medical office, contractor, or any business that finances equipment and inventory, credit may be part of the oxygen supply. Watch early signals, hiring freezes, fewer shifts, reduced overtime, delayed reimbursements, slower vendor payments, smaller inventory orders, travel cuts, management suddenly talking about essential spend, or invoices taking longer to move through accounting. None of that proves disaster. It tells you to tighten your household plan before your paycheck forces the issue. This is where emergency cash stops being boring. A 401k is important for the future, especially if there is an employer match, but a retirement account is not clean cash for next Friday. Pulling from it can mean taxes, penalties, paperwork, and regret. In a tighter credit environment, cash is not lazy. Cash is optionality. It lets you make a decision without begging a lender to make one for you at the exact moment lenders are becoming pickier. Now, what does the stress test not settle? It does not settle every future banking risk. A stress test is a model. Models are useful. Models are not magic. The next problem has an annoying habit of not politely matching the last spreadsheet. Some risks can sit outside the clean headline. Sudden deposit movement, local commercial real estate pain, non-bank lending stress, market confidence shocks, cyber disruptions, or a recession that hits Texas energy, California tech, Midwest manufacturing, New York offices, or Florida real estate differently than the national average. Unrealized losses are another plain English issue. That means assets, like certain bonds, may be worth less on paper than what the bank paid, even if the bank has not sold them and locked in the loss. It is like owning a house that an estimate suddenly marks down. You have not sold it, but pretending the lower number cannot matter would be adorable and wrong. A stress test is a dashboard check. It is not a lifetime warranty. If the warning light is off, good, keep driving. but do not throw away the seatbelt because one diagnostic scan looked clean. There's also a capital rule wrinkle going into the next cycle. Banks hold capital partly because regulators require cushions. Those cushions influence how aggressively banks can lend, compete for borrowers, buy back stock, or pay dividends. A dividend is cash paid to shareholders. A buyback is when a company uses money to repurchase its own shares. For banks, those payouts matter because money sent back to shareholders is money no longer sitting there as loss-absorbing padding. So future bank headlines deserve a sharper lens. Do not only ask, did banks pass? Ask, what happens to their stress capital buffers? Ask, are capital requirements rising or falling? Ask, are banks being allowed to return more cash to shareholders, or are they being told to keep more cushion? If banks must hold more cushion, they may lend more carefully. If they can hold less, they may compete harder, but the system may carry less padding. There is no free lunch. There are only different people insisting the bill belongs somewhere else. So what should you actually do this week? First, check deposit insurance while things are calm.
Look at checking, savings, CDs, business cash, payroll accounts, tax reserves, escrow accounts, and temporary large balances from a home sale, inheritance, bonus, settlement, or business revenue. Confirm the institution is FDIC insured or federally insured by the NCUA. Confirm the legal institution name. Confirm the ownership category. Confirm beneficiaries or account titling if you use trust-style accounts. If one institution holds more cash than the insured amount for your situation, split it, retitle it, or use a deliberate insured cash management setup. This is not about being dramatic. It is about knowing whether your money is sitting behind the insurance rules you think it is sitting behind. Second, ask better bank questions before rumor season. Are all my accounts at the same insured bank for coverage purposes? Do my beneficiaries change the coverage category? Is this CD directly held at the bank or brokered? Is my brokerage cash in a bank sweep program or a money market fund? Which sweep banks hold the cash? Could one partner bank be duplicated across multiple brokerage accounts? What are my daily transfer, wire, ATM, and withdrawal limits if I need to move money? Ask when everyone is calm, not when customer service has a 2-hour wait and the internet suddenly turns into a bank liquidity seminar hosted by people with 8 tabs open and no sleep. Third, build a cash buffer that matches your real risk. A simple design is 1 month of core bills and checking, 2 to 3 months in an insured high-yield savings account, and more if your income is variable, commission-based, small business dependent, or tied to a credit-sensitive employer. Core bills means housing, utilities, groceries, insurance, minimum debt payments, transportation, and medication. It does not mean preserving the exact subscription ecosystem that somehow grew inside your budget like mold. If cash is short, start with $1,000, then 1 month of essentials, then 3. Specific beats inspirational. Fourth, reduce credit utilization before lenders reduce your choices. If you plan to apply for credit soon, pay down cards with the highest utilization, not only the highest interest rate. Avoid unnecessary new debt in the 60 to 90 days before a mortgage, auto loan, HELOC, personal loan, or business line application. Replace the dead refrigerator if you must. Finance a luxury upgrade right before underwriting. No, the bank is not judging your personality. It is reading your file.
Fifth, prepare documents early if you may need credit in the next 6 to 12 months. Gather tax returns, W-2s or 1099s, pay stubs, bank statements, mortgage statements, student loan details, insurance costs, business financials, and proof of irregular income. If you own a small business, update your profit and loss statement and clean up bookkeeping before renewal season. Underwriting gets slower when banks get cautious. The household or business with documents ready gets to look boring. In banking, boring is a compliment. Sixth, audit job risk without letting it run your life. If your employer depends on borrowing for payroll, inventory, vehicles, equipment, receivables, real estate, or expansion, pay attention to early signals.
If hours get reduced or overtime disappears, do not wait 6 months to adjust spending. Build a small gap between income and expenses now. Quote insurance, switch some grocery staples to generic, delay a phone upgrade, pause a vacation deposit, review automatic payments, and cancel subscriptions that quietly turned your checking account into a donation program for apps you barely use. The point is not to live scared. The point is to stop treating available credit as an emergency fund. Credit limits are not promises. Banks can cut them. Lenders can change standards. Approval can go from probably to please upload 12 documents and explain this $47 transfer from March. If your plan only works when credit stays easy, the plan is weaker than it looks. After the headline fades, track 4 signals. Watch stress test capital buffer decisions because they influence how banks price risk and how much cushion they must hold. Watch FDIC quarterly banking updates for deposit trends, unrealized losses, liquidity, and problem loan categories. Watch the Senior Loan Officer Opinion Survey because it tells you whether banks are tightening or loosening standards before that reality lands in your own application. And watch consumer credit signals like card delinquencies, limit cuts, auto loan stress, higher minimum payments, and shrinking promotional offers. The 2026 stress test says the largest banks can take a hit. That is good news. But your household plan should not stop at banks past. Your plan should ask, is my cash insured? Is my account structure clean? Is my borrowing profile ready? Is my employer exposed to tighter credit? And do I have enough real cash to avoid begging for credit when banks become pickier? Because in a stress-tested system, the bank may be built to survive. Your job is to make sure your household is not the shock absorber.